Hey guys, Joel Franklin, market analyst for YouTrading, and in today's educational video, we're going to be taking a look at how Fibonacci retracement structures or patterns, or whatever you want to refer to it at, Fibonacci retracements, can be implemented into your trading. Now, the example I want to use today, because it's a good one, is Bitcoin. Bitcoin has a history of responding well to technicals, probably because it's traded as quite an emotional asset class with a lot of retail traders driving the action. But anyway, you can see here I've drawn a Fibonacci retracement from the March 2020 lows when the pandemic initially hit and started spreading. That's around 4,000 to the November 2021 record highs that we hit, that was around 69,000, close to 70,000, as a result of all that stimulus that we had from central banks and fiscal monetary authorities. But anyway, you can see here on the retracement back, because this is when the Fibonacci becomes relevant, once you've hit that peak or low, you start retracing back. You can see that immediately these levels become quite important. The 23.6% retracement was actually support briefly. Then it broke out to the 38.2% retracement support initially, then we broke below it, and then it became resistance. Then we chopped through it a little bit, and then we headed lower. But you can see that actually the 50% retracement was also not exact, but it was still acting as a pretty decent area of resistance. And then when we broke it, boom, look at that drop. This area here, the 61.8% retracement, decent area of support. 78.6 retracement, decent area of support again, and now it's turned into resistance. If you want to zoom in a little bit more, you can see that a couple of days ago we tried to get above it and failed. But I can't delete all of these easily. These Fibonacci retracement pattern levels are important to look at over longer term time horizons, but they're also quite useful over short term time horizons. Let's zoom in a little bit. So this crash that we saw on Bitcoin here, we were around 21,500 in that region, and within a couple of days we'd fallen to fresh annual lows under 16,000 or in the mid 15,000s. That was triggered by the collapse of FTX, which was at the time like the second or third biggest exchange in the world. But actually they were fraudulent and insolvent, as we've subsequently found out. But anyway, let's draw a Fibonacci pattern, and you can see that it's being responded to on the shorter term horizons quite well. The 23.6% initially acting as resistance. I mean, initially people might have thought that this was the bottom, and so these two, it doesn't really matter too much whether you use the 21st of November as the bottom or the 9th of November. But anyway, acting as pretty decent resistance. Then we broke above it, and it was acting as pretty decent support here. Then we broke higher, got to the 50 nearly, but wasn't quite able to get above that. Was a decent area of resistance. And now you can see we've fallen back below, but now we're sort of magnetizing towards the 23.6% Fibonacci level again. So their support, they act as support and resistance, just like recent lows and highs do. Let me give you an example of traditional support and resistance, like these recent lows that we had in September and mid-October, acting as resistance. And with your trading, guys, when you're using technicals, what you want ideally is to have a few different technicals pointing in the same direction. So for example, let me draw up that Fibonacci again. You can see here that when Bitcoin got back into the 18,000s, it was hitting this resistance here in the form of those recent lows. It was hitting its 50% retracement back to the early November highs. And it was hitting its 50-day moving average. So quite a few areas of significant resistance. So that's three points of confluence that could potentially have encouraged some shorts, some bears to add to short positions, contributing to this turnaround. Obviously, there was fundamental factors involved as well, like the hawkishness of the Fed the other week. But yeah, you wanna combine these Fibonacci's with other technical indicators is pretty much my point. But yeah, guys, hope you all enjoyed the video. Hope you all found it informative, and I will see you all in the next one.